Welcome to Kaiser Watch with John Kaiser. I'm your host, Jim Goddard. Best of the season, John. What's coming up on today's show?
Well, this is the last show of the year, and we're going to talk a bit about what went right and what went wrong, and what we might be looking forward to in 2024.
Why do you think the Canadian resource junior ecosystem may have crashed through its extinction threshold?
I think this time around it is dangerously close to having really happened. I thought it had happened in the middle of the past decade, in sort of 2015, that period where conditions were even worse than they are today in terms of traded value and volume. But we are now have been in a secular bear market since 2011 for a dozen years, and there were only a few short-lived and quite concentrated rallies, such as 2016, the second half of 2020, and briefly in early 2022, before the Federal Reserve realized that the inflation was not transitory and started to a period of sustained interest rate hikes. Now, the 2016 rally was based on what at the time appeared to be a rebound of gold, which had managed to get close to $2,000 in 2011, but then retreated. That rally didn't last because it was a false reversal by gold. So by the end of 2016, that had failed again. The second half of 2020, gold did make it through $2,000 in the second half, in response to the whole COVID pandemic and all the fiscal stimulus that was done to keep the economy from entirely tanking. But again, $2,000 failed to be a floor for that. Now, the 2022 rally was interesting because it was driven by geopolitical factors, and these really came to a head when China's Xi Jinping embraced Russia's Vladimir Putin after he invaded Ukraine. And this invasion of Ukraine was insane. Annexing Crimea a number of years earlier was bad, but this was him declaring this entire country, it's not a real country. This is a slave nation that needs to be part of the great Russian Slav nation. And what this conflict did was suddenly people woke up that there was this conflict between the global West and the new global East, with China and Russia as the heads of it, and then the global South, which in the past tended to be divided between the West, the United States, and the Soviets, the communists. But now there is this global South, which is all these emerging markets, which includes many of what were once called the BRICS. And they didn't take sides. They said, well, we're going to see who butters our bread the most, and we'll align with them. And this was a new awakening, because the big elephant in the room was the fact that the autocracies are the primary suppliers of the world's raw materials, even though the autocracies are a smaller portion of the global GDP than the democracies. And but that rally, it fizzled in 2022, because by the middle of the year, Powell had realized that no, this inflation is not transitory. It is now structural. We better deal with it. And so we saw this series of interest rate hikes, which turned 2022 into a bloodbath for general equities. Everything got pounded. Now, at the start of 2023, I felt that the resource juniors, even though general equities were still going to be stuck dealing with high interest rates, I felt that we were on the cusp of a major secular bull market for the resource juniors. And there were two reasons. One, the geopolitical situation had not gotten better. Putin had not retreated. Sanctions had not worked. The war was ongoing. China was becoming more and more aggressive in its stance in terms of, wanting to be the boss in its own backyard and annex Taiwan eventually. And so And the other big thing was 2022. What sort of bucked the trend was the price of lithium carbonate, and the market realized that, oh, this electric vehicle thing, it's not just a talking point for the climate change people. It's actually happening, whether or not it's driven by government policy. And in 2022, the supply-demand imbalance for lithium supply and EV-related consumption, it reversed, and we had lithium carbonate increase 10 times from its sort of low at the start of 2021, and it spent all of 2022 in the $30 to $35 a pound range. And it was at the start of this year that the IEA published an updated paper in which it explained what the requirements were for the different energy transition technologies for the goals, for the emission reduction goals for 2030. And when I went through that, I kind of realized, okay, here are actual numbers saying stuff like, we need 50% more copper supply than is being used now by the general economy by 2030. We need 100% more nickel supply, and we need, and this was stunning, we need 600% more lithium supply by 2030 than was produced in 2022. And in 2022, that was 130,000 tons of metal equivalent that was produced, and that was up more than 10 times what it was a decade ago. And when we started to quantify what all these electric vehicles would require if lithium ion remained the signature technology, I realized, wow, there's going to be a lithium component to this boom. We're 7 years away from 2030. It takes at least that long to mobilize new supply. We should have a major lithium exploration boom, in particular for pegmatite, because you can find the pegmatite, you can measure its grade and figure all out what it takes to put it in production. But there's also the clay stones, and then there's the salars and the oil brine fields. And the oil brine fields requires technology that is not yet proven but could be a big part. And claystone itself, because of the low grade and the complex processing required, that's an uncertainty too, and we'll know in a few years whether they figured out the technology to mine these claystones. But I figured with geopolitical supply disruption, with the global East squaring off against the global West, and at the same time the global West pursuing these energy transition goals, which China, as a key member of the global East, is also pursuing because it itself is also vulnerable to oil consumption and wants to move as far away from oil import dependency as possible. I figured these would be the big macro drivers this year. But again, I proved completely wrong. The interest rate hikes continued. By the end of the year, $5.2 trillion was parked in short-term money market funds, earning around 5% or a little bit more. That is the highest amount ever. The resource juniors, by the second half, they had given up all hope about a bull market, and we started to see a capitulation type of selling come into the market. Financing dried up in the second half. Prices got so low, ridiculously low, that at the end of the year, these flow-through funds, which had raised a bunch of money from people hoping to defer or avoid taxes, they couldn't find companies to place it with because the companies just didn't want to finance at 2 cents, 3 cents, 5 cents and dilute their future out of existence. The other thing that happened was whatever happened with the general metal prices. The lithium price itself had started a decline because of the reversal. The Chinese post-COVID recovery was not anywhere near as strong as expected. In fact, it was quite feeble, and it's still not clear whether they are going to pull themselves out of their COVID real estate induced slump. But the pegmatite exploration in places like Quebec and Ontario, that was going to be about boots on the ground, visiting these known showings, areas where pegmatites had been documented in the past, check them out to see if they are the LCT type that has potential to be 1% plus or more. And in early June, something unprecedented happened. Quebec and many parts of Canada just plain caught fire. And all of a sudden, all helicopters, everything were sequestered, requisitioned for supporting the defense of communities against these forest fires. And so the James Bay region in particular was closed until some areas opened up in early August. And even then, it was difficult to mobilize exploration crews because helicopters were still being used elsewhere for all kinds of support issues. So an entire season pretty much vanished, and all this boots on the ground prospecting that should have delivered up all kinds of drill targets by now, it barely happened, only with a few companies. And of course, at the same time, the lithium carbonate price has sunk all the way down to about $6 a pound, where people are worrying, is it going to go way back below $3 a pound like it did in 2018 to 2020? It might end up going a little bit lower, but I think the demand for electric vehicles has grown so much that any further drop, it will be temporary. And in 2024, Americans can buy a qualifying electric vehicle and capture the IRA $7,500 rebate right off the sticker when they pay for the car. This year, they had to pay the full amount, and in April, when they file their returns, they can apply for a refund for it. And that kind of killed the enthusiasm for buying electric vehicles. So I think we may see the electric vehicle demand pick up in 2024. But the other thing that's going to be a factor is 2023 was a year when Toyota, which had been a laggard in terms of EV deployment, suddenly came out and declared, we have done a major manufacturing breakthrough with the solid-state lithium-ion battery, and we've got a model coming in the next couple of years that can do 1,200 kilometers on a 10-minute charge. Those types of numbers make internal combustion engine cars not very interesting. But the commercialized rollout where they're selling cheap models like Camry and Corollas, that's not happening to 2030. So I think heading into 2024, after this big supply-demand imbalance has reversed in the opposite direction, we will see lithium carbonate prices and lithium hydroxide and so on recover and stabilize somewhere. Who knows, if it stays around $10, that would be absolutely wonderful, because to develop these pegmatites, we need $5 to $10 a pound lithium carbonate. In that range, a 1% deposit is worth $500 a ton, which makes gold deposits, open pitable gold deposits, look pathetic in comparison. So the other thing about for 2024 is, even as we speak, Russia has launched the harshest assault on Ukraine. It's like they've been listening to all their poodle pals in America who are saying, go for it, Vladimir, go for it, show who's boss. Take out these Ukrainians. We don't really care for these freedom-loving people. We like a good leader who can stomp on those who are too weak to defend themselves. And he's doing exactly that, because you've got one political party and its leading candidate for president, all kind of poodles of Putin and autocracy. So that's going to, I think, continue to ratchet up geopolitical concern, because the ugly truth is, if America does become an autocracy, it's going to be an autocracy learning how to be brutal with half the population resisting, and China and Russia, which are already brutalized autocracies, they're going to team up to take the boots to the American rump if indeed America aspires to be an autocracy. And the rest of the global West, they know they're going to be on their own. They're not going to be particularly keen to support the United States. So when this happens, the world's largest economy may find that producing less than 10% of all the various materials, except for a few things like oil and natural gas, is going to be a serious problem. So the groundwork's in place for a major turnaround, secular turnaround in the resource juniors in 2024 that I thought should have happened in 2023. The energy transition will still continue, will still be part of it. And of course, we've been hearing reports about how people are raiding their Costco's and their Walmart's big box stores and buying physical gold in anticipation of a very convoluted future, and maybe in anticipation for the fact that if Trump becomes president and does actually act on introducing major tariffs against Chinese imports, those shelves in Walmart are going to be either empty or filled with very expensive made in America goods, except they'll probably be empty for a long time because it will take quite a while to ramp up manufacturing capacity in the United States to refill those shelves that are no longer being supplied by cheap stuff made in China. So I'm pretty bullish that in 2024 we will have sort of the macro drivers for a stronger resource junior sector. But that wasn't the question. The question is, why do I think the Canadian resource juniors have fallen through an extinction threshold? And in the case of the Australian companies, I'm not saying that about them. I think Australia has handled its resource junior ecosystem very well, and they are in fact over here in Canada and the United States starting to do exploration. And I myself, I've been tracking these companies. I'm starting to think I need to put a lot more attention onto Australian listings, because North Americans can increasingly start to trade Australian listed companies through various brokerage firms such as Interactive Brokers. And if the Canadian ecosystem is crashing into oblivion, there is a way to continue to be immersed in this game. And that there are four structural problems that I see afflicting the Canadian companies that are not afflicting the U.S. one. One is the Canadian government's embrace of First Nations as a type of special aristocracy, which Prime Minister Justin Trudeau has empowered with a cudgel called reconciliation, which allows any First Nations group to stand up and object to a mine or an exploration drill permit in their backyard just because they now can. The second problem is one that applies to both Canada and the United States, and that is a very powerful, not in my backyard, NIMBY anti-mining lobby, and it has a fundamentalist mission to make sure that mining of the materials that underpin their comfortable lifestyles is only done in jurisdictions run by autocrats who are able to dump costs onto powerless downstream victims. The third is a financial sector exclusively focused on padding its members' wallets and absolutely oblivious to systems that serve a common good, such as resource juniors exploring for metals whose supply would allow members of the Global West to escape the tyranny of the Global East and secure the inputs for the energy transition. And the fourth, the absolute worst one of all, is a regulatory infrastructure that views investors as imbeciles and goes out of its way to keep them that way. Now, the First Nations and NIMBY problems, they hamper the ability of resource juniors to conduct exploration on a timely basis. The financial sector undermines the ability of resource juniors to fund their exploration activities and achieve price discovery for fundamental progress delivered by exploration results. And that may be a mouthful, but that is a very important mouthful. And the regulators are the worst because they pretend that keeping investors ignorant and stupid is in their best interest.
Why do you think regulators believe keeping investors stupid and ignorant is in their best interest?
This year, the regulators introduced something called CEDAR Plus, which replaced cedar. And we had an episode where we went extensively into that earlier this year. It was in the summer, late summer, that they finally rolled it out. The old cedar was invented around 1999, 2000, both in response to the internet becoming mainstream and to the regulatory response to the Bre-X fiasco, which completely embarrassed the Canadian mining industry and also the regulators, because this was an outright fraud that achieved multi-billion-dollar valuations, captured the imagination of everybody, and then demonstrated everybody to have been a buffoon. And the National Instrument 43101 was invented or created to develop standards, reporting standards, disclosure standards with accountability, qualified professionals that had to sign off, all built into it, so that something like this could not so easily happen again, and which also gave the regulators tool to look at the disclosures of companies and check with expert third parties and make sure that everything was up and up. But the CEDAR filing system, it was a free system. Initially they had Word documents, but eventually they had PDFs, and the companies were forced to make their regulatory filings as PDFs. And the most important of these was the financial statements, quarterlies and annuals, the management information and annual meeting circulars, and most importantly, the technical reports. Now, the Australian reporting system is superior in all regards except in terms of technical reports. And these technical report filing that the Canadian regulators introduced, which you could, if you went to the landing page of CEDAR, within about 3 clicks, you could be in the chronological list of a company's filings and look through it and check to see, where is it? You could get it. We had during the 2000s, during the China-driven super cycle boom, we had Australian listed companies intra-listing on the TSX, where they didn't trade very much, but they did that so that they would be forced to prepare a technical report and file it. For what changed for the juniors in the 2000s was that when the China supercycle drove up metal prices by an order of magnitude, in real terms, it had been like, for decades, metal prices in real terms had been in a decline. But all of a sudden we had real prices, and all these juniors found all these forgotten deposits that didn't quite make it in the 80s and 90s. But suddenly in the 2000s, they were in the money, and institutional money discovered the junior company. And there was a couple $100 billion worth of takeover bids done between 2002 to 2012. And compared to, say, $10 billion in the 80s and 90s before that. So the regulators had created something fabulous, the CEDAR filing system. It was readily accessible. It was free to the public. It forced the companies to provide excellent information. And this was working really well, and the regulators decided they needed to fix this. So what they introduced was something that is no different, except that it takes 20 clicks or keystrokes to get a document, when it used to take only a couple keystrokes. And if you bookmarked the link to a company that you were following, you could click that, and boom, you'd see all the listing. But even worse, even when you found, say, the technical report, it was the URL that they served as they delivered to it. It was a one-time ephemeral URL. If you bookmarked it and clicked it again, it delivered nothing. So what they did was somehow make it very hard for investors to find these documents that they needed to understand what a company was all about, to make their own decisions. How do you accidentally do something so unproductive and stupid? It's not possible. It has to be deliberate. That's why I can pound the table and say the Canadian regulators want investors to be imbeciles. They want them to stay stupid. They have created structures to make it very difficult to find this information. And the companies aren't required to have this information on their websites. Some do, some it's late, sometimes it's a strange format. And the stock exchanges themselves, while the CSE does a good job of putting it all available, the TSX Venture, they do a horrible job of making this information available. So there is this bizarre hostility towards keeping investors informed, making it easy for them to stay informed and become more educated about what is going on with these resource juniors. And you need to be, because the resource juniors aren't covered by institutional analysts, brokerage firm analysts. It's covered by individuals and a few newsletter writers such as myself, but I can only cover so and so many of them. So it's up to the individual to research and follow these companies and understand what their story is all about. It is insane that the regulators invented CDR Plus, which should be really called CDR Click a Lot, to get nothing.
How does the financial sector undermine the resource juniors?
The financial sector used to play a very important role financing companies, and there was a whole class of brokerage firms which specialized in the juniors, and that all kind of disappeared in the 2000s when the juniors grew up and became involved in feasibility demonstration plays rather than discovery exploration, and the internet came along and discount brokers. So the traditional role of a broker as an information hub, it kind of disappeared. And then more and more regulatory concerns, litigation about did you abuse the client, did you not put them into the right stuff. The brokerage firms gradually moved away from servicing customers on a full service basis. And the regulators themselves, as part of their you are an imbecile, and if you're over 55, you shouldn't even be allowed to trade stocks. And full service brokers, in some firms, they were forbidden to take an unsolicited order to buy some junior stock and just trade it, because the danger was that if this person passed away from a stroke, their greedy children would look at all these reports of the positions that lost. They'd ignore the ones that made money, and they'd go to the brokerage firm and say, how could you let mommy or daddy have bought these losing positions in these high-risk juniors? And of course, the protest, well, it was their idea and not mine. That didn't wash. So they've drifted away, and all these people who like to trade this sort of stuff, they ended up moving to the discount brokers, because Canada hasn't quite reached the point of a super nanny state where they forbid you from buying anything but government bond type of instruments. So people have been pushed out of the brokerage industry. The brokerage industry just places, bought deals on that, which are large, with institutions and a handful of high net worth investors. So their role in financing these juniors and providing some sort of research coverage and talking to their clients about them, that has pretty much vanished. But there is something else that's insidious, because external information systems have emerged. There's Stockwatch, there's services such as mine, there's other newsletter writers, there's all these online bulletin boards where you can go and people talk about stuff, and you can sort of try and figure out what's real and what's not. So, the resource junior sector could adapt to the disappearance of the brokers as a relevant aspect of the whole fundraising and explaining cycle. But the insidious thing that happened is the brokers and the regulators collaborated to allow alternative order execution platforms. So rather than there just being one utility such as the TSX Venture exchange, where a listing, all trades would go into the order book, and the first come first served principle could be observed, they said let's create competition so that the TMX group doesn't end up gouging everybody. But of course, once you fragmented the market like that, the brokers were still stuck getting the best fill for their clients. That was still a rule, but they were able to electronically to look at these multiple order books, and each of these order books had their own fee schedule. Some actually paid you for an order, whereas others charged you if you did a market order to a limit. And the brokers would create these programs that would calculate what is the cheapest cost to execute a fill on this client's order. And then they would submit it, and it would weave its way through all these different order platforms and fill your order. Now, the saving that they had was not passed on to the client. It became part of their profit. They kept that saving. They still charged the client the same commission for executing the order, regardless of what it actually cost them to execute. But the problem with this type of system is that there are different execution speeds. And there was a valuable rule in the old days called the uptick rule, which applied to short selling. And in short selling, you were only allowed to sell short, and selling short is selling stock you don't have in your account, if the price you are selling at is higher than the last different price. Now, in order to show you're in compliance with that, you need to be able to show in the execution chain that, yeah, your short sale is at a higher price than the last different one. But when you are putting orders into these multiple execution platforms, that's not possible to prove anymore, because if it's a market order going through all these different parts of it, you don't know what actually was the last price. And the Americans were the first to eliminate the uptick rule because they developed these derivative markets and ETFs and these index products, and traders would be, the algos would be busy arbing between them, and it was all justified in the name of creating efficient markets so that this instrument over here wasn't higher priced than its equivalent over there. And so this was designed to shrink it. But again, it had the same problem as you were selling short in one market and buying long in the other, and you were doing it at a high speed. And so you had to get rid of this rule of uptick rule. So they did that. But for the Canadians, the unintended consequence was that once they eliminated it, the brokerage firm set up these trading departments, and they would then specialize looking at these resource junior stocks. And they would watch for incoming buying. Now, most of the time, a resource junior stock doesn't trade very much. It sits there. We're waiting for expiration results. Out comes a news release. Oh, it looks good. Buying starts to come in, new money, which sees, okay, the story's becoming more real. We're still not at a guaranteed billion-dollar valuation, but we're an important step closer. And so they start buying the stock and coming in. But these days, there is no way for this news to be seen by many eyeballs that all focus on it and all engage in an argument. So a fragment of the potential audience charges in, buys this, and there are these predators sitting there, and they wait for it to start to rise, and then they start shorting into it. And of course, they're competing with the insiders or second-level insiders, that was the secret backers behind the company, which often are brokers themselves, who are also selling into this incoming buying. Now, in the old days, you could only sell while it was trending higher. But now you can sell while it's going up, and then when it starts to falter, you can keep selling stock you don't own. There is still a problem, though. You still need to borrow stock to deliver at the end of the day to settle the trade. But all you need is to intend to borrow the stock. And if by the end of the day you've bought it back, the short never happened, and you don't need to execute on your intention to borrow. But now we have this situation, like back 20, 30 years ago, people saw what their stock did the next day when they cracked open the newspaper or happened to call their broker, who told them, well, it's doing this and this and that now. Now, everybody monitors their positions almost on a real-time basis. So when they see a stock rallying, they go, yeah, it was long bottom, there's a bottom fish, it's going great. And then they see it stall. And then they see it start to go down. And they don't understand why. And what's happening is these traders are selling short, leaning into the bid side of the order book, painting the tape with a downtrend, which then spooks the longs who are watching all this from the sidelines into panicking and selling to accelerate the downtrend, which enables the traders to cover their shorts by the end of the day and never have to borrow stock. And it's really quite hard to borrow stock in the juniors because they're all now in cash segregated accounts. Nobody's allowed to be overdue anymore. You can only buy stock with the cash in the account. So the brokers can't borrow it like in the old days where as soon as it was overdue, everything in it could be rated by the broker to lend to the short selling customers of the firm. That doesn't exist anymore. So it's really hard to borrow stock. So what these financial sector now does, it's like this big squid or whatever, sucking in the risk capital, sucking out the risk capital and putting it in its own pocket. And it's not serving any purpose. It is not like short selling an overpriced stock and protecting buyers from paying too much for something that doesn't deserve to be assigned. This is risk capital harvesting. And when there's these different groups moaning and complaining about naked short selling, most of the time, these are just insiders who are pissed that there is competition selling stock into the buying that they're busy promoting to come into the market. But what these traders are doing, this is very insidious. It prevents a stock from achieving a sticky increase in valuation based on new information, on positive information. And this totally undermines price discovery and the ability of companies to raise more capital at better prices to continue the exploration cycle on a particular project. This is a structural problem that exists in Canada, and the financial sector is happy with it, and the regulators appear to be happy with it. And this, I think, is something that could only be solved by reinstating the uptick rule for short selling and having a single utility, a single order execution system where the last trade is always a visible benchmark that can determine whether you sold short illegally or legally.
What is a solution to First Nations and NIMBY opposition to exploration and mining?
Well, last week I talked about, or a couple of weeks ago, I talked about the anti-mining lobby as basically being hypocrites who think they're champions of freedom and democracy, but they're actually unwittingly, or perhaps in some cases wittingly, supporting autocracies by preventing nations in the global west where people actually pay attention to environmental rules and the victims downstream from even getting drill permits, let alone mining permits. And the result has been a skewing of supply to autocracies who in a lot of cases are autocracies because they're naturally endowed with raw materials at good grades, and so they can dominate in the supply of this. But they also don't care about the downstream. Russia is one of the nastiest, worst polluting countries in the world, and China competes ardently with it. It does worry a bit about, because there's such a large population, about people downstream getting upset about all the garbage being dumped downstream. But China is a communist totalitarian state, and it can always argue that the suffering of the individual is for the collective good of the state. And in Putin's case as well, it's for the collective good of the oligarchs, and not so much you, but you have no say, so just screw off. What has to happen is the NIMBY crowd needs to be educated about what they are actually doing. And I think countries like Canada have done a shabby job educating young people about where stuff comes from. How is it mined, and how is the rules for mining it in Canada and the United States different from, say, Congo or China or Russia? And so it's really by shaming and educating this anti-mining lobby. And even with my own children, I'm shocked when they sort of say, well, mining's bad, and especially bad when it's done in our country. And then they kind of like stare at me with open eyes when I show them where it all comes from and how it's done and what they're actually supporting. So I think that's the path to deal with that. And I think next year, maybe the year after, when suddenly we're not getting this stuff from our enemies anymore, and that may be because the global East and global West are now at total loggerheads, or because the United States has become one of the competing Global East members, so they all hate each other and are busy screwing each other. That's going to be the time when everybody wakes up and says, okay, why aren't we producing more of this stuff? It's there. It has it has maybe a lower grade and higher cost, but we still need it for our stuff, and we can do without a bunch of other stuff that we don't need. We can funnel our resources into this. So that's what I think will happen to deal with the anti-mining lobby. In the case of the First Nations lobby, the first thing to do is get rid of this Prime Minister who doesn't understand that Canada's future is as a resource-producing nation, not as a reconciliation-granting nation. And the First Nations themselves, a lot of them are proactive. They want to be engaged in the local mining industry. They sit down with companies. They figure out what they're doing. They say, okay, well, here's the areas where, we don't want you to go, and hire some of us to do this. And maybe at the end of the day, when you're ready to go in the mine, maybe you share a percentage of this to help our local community. And that needs to be encouraged. What needs to be discouraged are the ones who are absolutists, who get hijacked by the anti-mining lobby and told it's their job as custodians of the wilderness to keep Canada a poor nation. That needs to be reversed. Right now, Trudeau's unleashed a juggernaut where First Nations have the ability, like one person with FPX Nichols Dakar project, after collecting the payments and whatever benefits for a decade and strip logging the mountain, they suddenly decide, oh, this is a sacred mountain. We oppose any mine for, whatever BS reasons that we can invent with for wanting this. And it's really basically an extortion ploy. This needs to be dealt with. Rules of fair play need to be established. That's what I think is needed to reverse this perception that Canada is becoming a no-explore zone for resource juniors, even though Canada is amongst the most secure in terms of rule of law and title.
I know your 2024 bottom fish collection is for KRO members only, but can you tell us the name of its strangest member? This one is even a shock to me. And by the way, for those who missed the last week's episode, for 2024, the existing all memberships will expire at the end of on December 31st of 2024, which is when I'll decide, if I'm going to continue doing it for another year. And people who are currently members, they get to renew at they've prorated whatever is left. If it's 6 months, it's half of 365 times 450 what you pay. But at the end of 2024, I will change the pricing model to $200 a month or something like that, auto renewal for all new members. Those who are members at the end of next year will have the option. They'll be grandfathered to renew at the old 450 rate, and they'll be able to do this as long as I continue Kaiser research online. And anybody, anytime next year, can subscribe for 450, but it's only 450 for the rest of the year. So if any of you are thinking that maybe 2024 will not be a crappy year like 2023 and 2022, in the next few weeks would be a good time to sign up and start following the 2024 bottom fish collection. So the company that I came across about 3 or 4 weeks ago is MetalX Ventures. And MetalX Ventures is Chuck Fitke's diamond exploration company. And it has been a super dog since it showed up in the early 2000s. At that point, its peak was 560 when it was exploring in the Ottawa-Piscat area. It eventually discovered the U2 pipe in the Kyle Lake area. It turns out to be only about 3.5 carats per 100 tons, but it's got really, really nice diamonds in it. But it's in an area where one of the Ottawa-Piscat nations is just not interested in mining, and it's also why De Beers shut down the Victor mine rather than expanding it for another decade or so. They are so hostile to anything in this awful part of the world of swamp and black flies and mosquitoes that, Victor is now reclaimed and gone, and U2 just sits there doing nothing. And in 2009, Metalex underwent a 10-for-1 rollback, which means that the original 560 was $55 a share. Now it's limping along at about 2 to 3 cents. Has about negative $200,000 working capital. There's $234 million issued, of which Chuck owns 35%, about 82 million shares. And of course, for those who don't know, Chuck Fitby was the driving force behind the discovery of the Ekati cluster through Diamet. He brought BHP on board. It was developed into a world-class mine that the BHP eventually bought at an implied price of $2.1 billion. Chuck had a percentage and a royalty, so he did extremely well. And he's devoted the rest of his career after that to trying to find another big diamond cluster. And one of the things he's done in the last 20 years is collect 10,000 till sample in Quebec, in particular the James Bay region, because the Renard cluster was found by Ashton and developed into a mine, and of course it's now bankrupt for the second time shut down. But this is an area that should have potential for diamondiferous kimberlite. And eventually he realized there wasn't anything showing up that pinpointed to any undiscovered clusters. He started going after the other heavy minerals such as gold, and started staking gold prospects, and he's got a couple of them, A1 and A2. They're fairly decent sized. They're between the Mirage project of Brunswick and between Winsome's Adina project to the south. And this year they did some work on their various fractions that they had separated. They discovered that in the intermediate sample, and that's sort of the lighter metals, not the one that has the garnet, the diamond indicator minerals, or heavy minerals such as gold. They discovered that spodumene grains were showing up in that particular fraction, and they've started to go through all this to see which of its 10,000 sample sites, which basically covers all of the James Bay areas, has kicks of spodumene, the key lithium mineral. And they were able to confirm that, yes, in areas where there are now CV5, Patriot Battery Metals CV5, yeah, you can see a train of these spodumene crystals showing up. Now, all the greenstone belts in the James Bay region are already staked by juniors who looked at a government map and said, well, they tend to be in these areas, so they staked all that. But there's still a vast area of James Bay that is not staked, and these areas are uninteresting because they don't have greenstone belts. But greenstone belts aren't necessary for pegmatite emplacement. They just happen to occupy structural zones that pegmatites like to follow as they migrate away from granitoid intrusive bodies. So he's now got a plan to go through all this, prioritizing the areas that are still open, to see if any of them light up. And this is kind of a variation of what Dios was doing with its much smaller scale indicator mineral sampling in the past 2 decades, because they were also a competitor in the James Bay region. But what Chuck Fitby has done over the last 20 years, and I don't know if it's $10-20 million worth of samples, this is on a monumental scale. Now, it may turn out to be the case that all these samples have nothing in it and there's really nothing interesting to stake, or by summer he may have identified areas where nobody ever went to because there's no greenstones nearby, but which are spewing spodumene grains. He can go in there unopposed and stake it and suddenly end up with potential major pegmatite fields in the James Bay region. For now, we have to content ourselves with A1 and A2. They did get into the field. A1 does have pegmatites on it. They didn't have an XRF or LIBS gun. They collected samples from this, and we'll wait to see if any of them have meaningful lithium grades and then get confirmed as spodumene. But in case you don't like a strange bottom fish like that a company that's been like a non-performer for more than 2 decades, they do have this
Vijonshof project in South Africa near Kimberley, which is kind of a pet project for Chuck Fipke, and they picked it up several years ago. A group owns, I think, earn up to 70%, but it's a bunch of kimberlites that are relatively small, found in the 60s by De Beers, discarded because it was too small and they were busy with bigger things. But apparently, it's got both garnets from both eclogitic and Hartspergitic xenoliths, and therefore very high diamond potential. They're going through the process of getting it converted to a mining lease so that they can do larger scale exploration. And this may happen, and this could be Chuck's new diamond find. It might be similar in sort of scale to what turned Southern Ura into a winner, the Marsfontein pipe that Chris Jennings found. This is a bit of a long shot that the South African government will ever grant this mining lease, but they have been plodding through all the steps and they're closer to the finish line. So that's the hedge against this really big potential story in James Bay, creating a winner that for Chuck Fipke eclipses what he accomplished with Diamet's Ekati cluster.
John, thank you so much for the update and have a great new year.
Yes, so hoping for a good new year, and to you too, Jim, and to our audience out there.
I'm Jim Goddard.
Comments made on Kaiser Watch are an expression of opinion only and should not be construed in any manner whatsoever as a recommendation to buy or sell any financial instrument at any time. Archived online at kaiserresearch.com.